$39 trillion. That is the gross national debt of the United States in March 2026. A number so large it has become a psychological abstraction. But abstractions don't require auctions. Reality does. Because when you owe $39 trillion, you aren't just borrowing once. You are rolling over a mountain of debt every single day. That mechanism runs through the Treasury auction, a process that just flashed a warning the world missed. Twice. The scale of this machine is unprecedented. Between 2025 and 2026, roughly $19 trillion in existing debt must be rolled over. That isn't new spending, it's just keeping the lights on. On top of that, according to the Congressional Budget Office's February 2026 outlook, the deficit for fiscal year 2026 is projected at $1.9 trillion. The machine never stops, it just gets heavier. In fact, in the first 5 months of fiscal 2026, the deficit has already hit $1.004 trillion. Logic over loyalty is the only way to read this math. And the logic of the 30-year bond is starting to change. To understand the failure, you have to understand the measuring stick, the bid-to-cover ratio. A healthy auction usually lands between 2.4 and 2.6. Anything below 2.3 is a sign of weakness. It means the world's most powerful borrower is losing its audience. And in 2025, that's exactly what happened. In February 2025, the Treasury issued $25 billion in 30-year bonds. The bid to cover came in at 2.33, below average demand. A warning shot. Then came August, another $25 billion auction. This time, the ratio dropped to 2.27, the lowest in nearly 2 years. The long end of the curve just asked for a premium. When investors walk away, primary dealers have to pick up the slack. They absorbed 17.5% of the supply, well above their average. The market was saturated. Indirect bidders, a proxy for foreign demand, fell to 59.5%. The signals were clear. The trust in America's fiscal future over 3 decades is wobbling. Twice in 1 year. The most visible subplot is China. At its peak, Beijing held $1.3 trillion in treasuries. U.S. Treasury TIC data as of December 2025 shows that number has fallen to $683 billion, down 47% from the peak. Not in a straight-line panic, in a decade-long deliberate strategic exit. Japan remains the largest foreign holder at $1.2 trillion, but they face their own bond crisis at home. They hold the most, yet their capacity to save the U.S. auction is shrinking. And Japan is not alone in its retreat. India, once a quiet accumulator of U.S. treasuries, has been deliberately repositioning its reserves. Not out of panic, out of calculation. The Reserve Bank of India has been shifting weight toward gold and shorter duration instruments. We covered that move in detail. The link is above. 3 of the world's largest creditors, China, Japan, India, are all making the same calculation from 3 different capitals. They are not abandoning the dollar. They are refusing to lend it back for 30 years. That distinction matters more than any single auction result. The math is brutal. A decade ago, foreign buyers held the mid-30% range of total U.S. debt. Today, that share has fallen to the mid-20s. We have spent the last several months mapping this machine piece by piece. BlackRock, managing more assets than most countries produce in a year, quietly began repositioning away from U.S. assets. Not selling, recalculating. $50 trillion in global institutional capital is repricing American risk. That video is linked above. Japan's domestic bond market is simultaneously facing its own structural crisis. A $9 trillion debt bomb that limits Tokyo's ability to keep absorbing U.S. paper indefinitely. That analysis is also linked. These are not coincidences running in parallel. They are pressure points on the same structure. And the 30-year bond auction is where that pressure becomes visible. When demand wobbles, yields go up. In 2021, the 10-year yield sat as low as 0.3%. Today it's hovering around 4.3. The cheap era of debt is dead. The result? Net interest payments have hit roughly $1 trillion a year. In fiscal 2025, according to Treasury Department figures, the gross interest bill reached $1.22 trillion. This is the interest trap. The math of the loop is simple and brutal. Weak demand leads to higher yields. Higher yields raise the cost. Higher costs require more issuance. And more issuance means the next auction matters even more. This is the loop. And we have officially reached the paradox. The paradox is now a matter of public record. The U.S. Treasury's own monthly statement confirms. In the first quarter of fiscal 2026, the United States spent $270.3 billion on interest. It spent $266.9 billion on its entire military. For the first time in history, the cost of the past is larger than the cost of the present. The United States now spends more on interest than on its military. That isn't a projection, it is the math. IMF COFR data shows the dollar still accounts for 57.8% of global reserves, but the share is shrinking. And remember, push rates just 1% higher, and you add another $187 billion to that bill. The margin for error is gone, and the calendar does not stop. Another 30-year auction is coming. The same foreign buyers will be in the room, or they won't. The short bill market is still 3.3 times oversubscribed. The world wants short-term America. What it is quietly refusing is long-term America. That is not a crisis. It is a verdict. And verdicts are harder to reverse than panics. The long end of the auction just confirmed it. If confidence has a price, and that price is rising, who pays when it becomes unaffordable? If this analysis added value, you can support the channel at the link below. Every contribution keeps this research independent. Because in the end, capital doesn't have loyalty. It has logic. Steve, signing off.